The purpose of due diligence in a lending transaction is to minimize the risk of the loan not being paid back, in full and on time. The lender takes a close look at the borrower, potential guarantors, and their assets and operations to verify the borrower's information and spot any credit risks. The lender and its lawyers participate in the process, each with a different focus. The lender conducts financial due diligence, either on its own or with the help of financial professionals and accountants, to confirm that the borrower is in good financial condition and that it will be able to repay the loan. At a minimum, they look through the borrower and guarantor's financial statements, tax returns, financial projections, and depending on the type of loan, appraisals or audits of the collateral. In addition, the lender's compliance department does a background check on the borrower, known as Know Your Customer or KYC. This is a federal regulatory requirement that involves verifying the borrower's name and the names of some of its beneficial owners against terrorist and sanctions lists. Financial due diligence is more likely to kill a deal than legal due diligence, so the lender typically does their diligence first before approving the loan, and usually before getting lawyers involved. After the lender is comfortable with its financial due diligence and the parties decide to move forward, the lender's lawyers start legal due diligence. Legal diligence is much less likely to be the reason a deal doesn't happen, because the types of problems identified can usually be fixed, unlike financial problems, which aren't as easily solved. Generally speaking, 3 categories of documents are reviewed during legal due diligence: the organizational documents of the borrower and the guarantor, if there is one, documents related to the collateral, and depending on the deal and circumstances, other non-financial materials. This might be material contracts and leases, existing loan documents, or SEC filings if the borrower is a public company. For some types of deals, there's an additional layer of diligence. For example, in an acquisition finance deal, where the borrower is using the loan to buy the target company, a comprehensive diligence review has to be done on both the target and the borrower. This is because the borrower uses the target's assets to secure the loan and plans to use the target's cash flow to pay the loan back. So, it's important for the lender to be as comfortable with the target company as they are with the borrower. This may mean that the lender's lawyers spend more time on diligence, or the lender might rely or piggyback on the diligence that the borrower does on the target in connection with the acquisition.